Some example of transaction: Goldfield in 2011 paid $661 million to purchase about 19% interest in iron gold in two mining companies, which reported $400 million after-tax gain on the sale. So they paid quite a bit of sale. One of the biggest case who kind of everybody like what was, and it's a complex transaction that it's hard to explain, but in a simple way, it's Heritage sold its Uganda interest to Tolo, which is an Irish company, for $1.5 billion. And then Tolo sold 2/3 of this interest to CNOOC, which is China Chinese company, national company, and Tolo for $2.9 billion. So these, before any oil was extracted from the field, these companies made hundreds of millions and $billions of capital gain without, like having to pay anything to Uganda. So the Uganda government was not very happy about that. You see, there's a number of other transactions. There's also the other area besides mining and oil and gas, where you see this type of huge transaction, is also in telephone. People selling their mobile phone, their cellular phone licenses. And there's a case with Vodafone in India, where there was $1 billion capital gain. So the extraction, I would say the sectors where you see the biggest of these gains: oil and gas, cellular phones licenses, and mining. These are probably the three areas where you see mostly of this huge capital gain transaction. There is a different type of transaction, and I think it's important to spend a few minutes to look at them. There's the sale of assets. There's the sale of shares. There's the sale of new shares resulting in a change of control. So there's a change of control, but maybe not like an arm's length transaction. Farm out, which you see in petroleum, not in mining. And overriding royalties that you see in mining sometimes and in petroleum. So we'll describe a little bit what are these transactions and whether it makes sense to have a capital gain taxes on these transactions. So obviously, sale of assets of a domestic company is the easiest thing. A company sells its license to another company. If it's done within the country and there is a huge capital gain, that's the easy thing, if it's done at the domestic level. The problem is that very often these transactions are done at a supranational level outside of the country. I see this, but in the case of asset of a domestic company, most countries, and I think it's the case in Mongolia, to own a license, you have to have a physical, a moral entity in the country. If it's the case, then if you sell like the asset, like the licenses and other assets, technically speaking, the asset has to be transferred from a domestic company, because you have a rule that the license has to be owned by a domestic company, to another domestic company. They want to be legitimate to have the license. So this is why very often these transactions are more like a sale of shares. And then there's a shares of domestic company held by a non-resident could be sold to another non-resident. So you have, in the super simple case, you have the company A, which is the parent company. They own A Mongolia, A Mining Mongolia. So what they're going to do is that they're going to sell, and here they own, like, let's say 100% of the shares. So what they're going to do, they're going to sell these shares to B, who will become the owner of A Mongolia. So the transaction will take place outside of Mongolia. And even sometimes there's a third level. It will be done at a higher level, but it's the same concept. So the problem here is that the capital gain is here. Here they say they've spent $100 million for the licenses, and they're selling it for $500 million. But so the gain, the capital gain, is outside of Mongolia. So the work you're doing to have to know the beneficial owners, who ultimately owns, the license, it's very important, because it will help be able to tax these companies at the higher level. So if the gain is realized, like in this simple example, by a non-resident, like by A here, gain may not be taxable under domestic law or under countries' bilateral treaties. So this is why countries now, like Mongolia, are introducing provision in their domestic law to be able to tax it. Because in a standard way, many countries could not tax these non-resident transactions. But now countries are putting provisions, as Mongolia, to be able to tax them. So, as I said, there's domestic law and there's tax. This is the same graph. So, domestic law could provide that a non-resident is taxable on a gain if 50% of the value of the shares directly or indirectly attributable to immovable assets in the resource country. So you could put provision in your law, and this rule would reach non-resident holding shares of an upper tier company, at the higher level. Under the OECD model treaty, but it depends what you have in your treaty, normally, this is the most important part, is that gains from an alienation of immovable property taxable in source country, like Mongolia, immovable property usually include mineral deposits or the right to work mineral deposits. So according to the OECD model treaty, you can consider your mineral deposit, i.e. and your right to work the mineral deposit, i.e. the license, to be considered as immovable property. So this can be like super complex. We could spend like 3 days discussing how to deal with this and the bilateral treaty consideration. So since this is just an overview, but this is a super complex problem. But could be fixed actually quite easily by a few provisions in your tax code. The next type of exchange control without sale or exchange is that so the other way to having a non-cash transaction in some ways, or a non-sale, is that A will issue shares. So they will issue, let's say they have 100 shares in the company, so they will issue 100 more shares that will be purchased by B. And here, B, if it's only let's say 80 shares, then B remains a minority shareholders. But if it's 125 shares, they have the majority of the shares. So without having like a proper sale, B becomes owner of A, and becomes owner of A here. So you can have a change of control without actually an actual sale of this. This company dilutes itself or can sell shares of this to another party, and it can be more difficult to show that it's an actual sale. So you need to provide that if there's a change of control, that it could be taxable. The other thing that you have to, and I think in your law, you have to have, like in terms of beneficial owner, having the company to disclose if there's a change of ownership of more than 5 or 10%. Because you have to realize that if B is listed, publicly listed on the stock market, there will be like dozens of shareholders, if not like thousands of shareholders, like C, D, E, F, G, you name it, and they will all buy and sell shares of A. And some of the time, if the deposit here is known to be like very important, there's news that the reserve are very high, the value of this will go up, the value of this will go up, and then these shareholders will make capital gain if they resell their shares that they have in A. So you understand that there's a limit to where you can go in terms of taxing. You cannot tax every single time that someone buy and sell shares of a company owning an immovable asset in your country. Because there's stocks, especially if the company is publicly listed. So this is why sometimes the rule is that you talk about a change of control. So if a shareholders, someone here come, X, and all of a sudden buy 55% of all the shares and control A, then you may see that you have a change of control and maybe a capital gain. But it's difficult you cannot start to tax every single time someone makes a capital gain on the transaction. The next type of transaction that I just wanted to show you very quickly is the farm out transaction. This happens mostly in oil and gas. I don't recall like a farming out transaction in mining. Probably they are, but I just don't remember any. So farm out is like, what happens is that an oil company discover kind of a major site, a major oil discovery, and they don't have the capacity or they don't want to take the risk to develop the whole field by themselves. So what they do, they farm out, they seek another oil and gas company. Normally it's a company, a good operator, and they tell the company, listen, we've spent money on exploration, we found this huge field, now we want to give you like 30% of the field. But in exchange for that, you will develop the field. You will spend money to do like the detailed exploration, to build a site, to bring the platform. So we're giving you the 30% for free. I shouldn't say for free, but we're giving you 30% in exchange for a work program that you're gonna develop the field for us. So we give you 30% without any cash payment, but you're gonna do an amount of work. And we will be partner at 30/70 the project. So in oil and gas, not quite often, but once in a while, you see this farming out transaction. In many cases, the only thing that the farmer does is they do the work program, an agreed upon work program or work commitment. In some cases, there's also a cash consideration. So there's an exchange of cash. So then the question that this is not really a sale. It's a sale in some ways, but there's partly, it's a work program, sometimes there's a cash payment, sometimes there's none. So if there's a cash consideration, a cash transfer, how should this be taxed as a capital gain for the farmee, the one who's farming out, part of the interest? So if the transfer of interest occurs when the arrangement is agreed, meaning that when the agreement, not when the work program is completed, but right up front, when the transfer of interest is made, the farmer could be required to recognize gain. On the other hand, if the cash payment occurs only after all the works has been done, the work program has been completed, then the cash should be considered as a bonus, meaning like the new coming in, like the farmee comes in and makes a payment, like a bonus payment to the farmer, and so it would be a revenue for the farmer, and the farmee, the one who has, let's say, 30% of the interest in the project, would become a deductible expense for him. So we discuss farm out because it exists, especially in oil and gas. So I think you should at least be aware of that. It can happen, and here there's a way to deal with it, but you have to know that this could be a possibility. The overriding royalty is another case that you see mostly in mining, where this company here will sell its interest to the senior, but there will not be a cash consideration up front. What they will get is that they will get 5%, let's say, of the revenue, like a royalty, that will be paid to the original owner of the license. So here there's no cash exchange for the transfer of license. It may be $1 for legal purposes, but the license is transferred to the senior in exchange of a royalties that will be paid during the life of the project. So you will understand that this is difficult because how they probably made a gain by having this stream of revenue for 20 years, but how do you value this and how do you tax it? Because they don't have the money up front. They will get the money each year. They're going to get 5% of this mine revenue. So as a point two, like it's difficult to put a value. So how do you deal with that? Because it's difficult to put a value. One option is to treat this as an expense for the payer. So this an expense, and the receivee, the one who receives it, is considered taxed as an income. So, and if these two parties are non-resident, if the transfer has been done at a higher level, what happens is that the seller will not be taxed on the income, but the one who's paying the royalty will not be able to deduct the payment of the royalty from its income. So, as I said here, two wrongs will be right. So nobody is taxed. So if the two transactions cancel each other. Another way that countries have dealt with this is that they impose a withholding tax on this payment. So they tax the gain because they couldn't tax it up front. But each year, each time this payment is made, they take a 15% withholding tax on. So in your tax code, to include, like if you have provisions for withholding tax, that overriding royalties could be included, specified as subject to withholding tax. So, and if you do that, what do you think will happen if you have a withholding tax on overriding royalty? Non-resident. Where this non-resident will somehow be located in the Netherlands or Mauritius, with whom you have a double taxation treaty. So this company, if before selling their rights for an overriding royalty, what they will probably do is create a subsidiary, a sister company in a jurisdiction where you have a double taxation treaty. They will tell you that they're transferring their licenses to this, but it's a within sister company, like transfer. So probably you will say yes, that's fine. But then, like the week after, they're going to sell their interest here to a third party, and then this would be, the payment will go to in a jurisdiction where you have a double taxation treaty. Because this is, as you can see, this and the farm out, they're very complex. So I was not, I didn't want to solve all of the issue here, but I think that you should be aware of what the issues are. And maybe along the way, in the coming year, if you need assistance to how to sort out these issues, maybe we could help. This question: if a company pays a big price to gain a license, normally they can amortize this extra cost. So if you tax the gain, the profit, then they'll be able to amortize the cost of this gain. So it's symmetrical, but at different point in time. In summary, I think, the question is there a taxable event? Like farming out, is it just a change of control within, the same company? Or is it a real change of control? Is there a gain? Is the gain of domestic source or foreign source? Is the gain should be taxed as ordinary income or capital gain? Do treaties limit domestic law? If non-resident are taxed, can the tax be enforced and how? So there's various questions, and as you know, there's the literature how to deal with this is very long. I mean, there's like hundreds of pages. So again, I was not hoping to sort out all the issues this afternoon, but at least that you're aware a little bit of the dynamics of farming out, overriding royalty, change of control, sale of shares versus sale of assets.